What financial jargon should Asian American entrepreneurs know for business loans? Have you ever felt overwhelmed by the financial terms when applying for a business loan? If you are an Asian American entrepreneur, understanding key financial jargon can make a huge difference in your loan application process. Let's break down some essential terms that will help you navigate the world of business loans effectively. First up is the minority business loan. This type of loan is specifically designed for businesses owned by minority groups, including Asian Americans. To qualify, your business typically needs to be at least 51% minority-owned and controlled. You may also need certification as a minority-owned business to access certain loan programs. Next, we have small business administration loans. These government-backed loans help reduce the risk for lenders. The Small Business Administration 7A loan is quite popular, offering up to $5 million with repayment terms ranging from 10 to 25 years. These loans come with relatively low interest rates and can be used for various purposes like working capital, real estate, equipment, or even debt consolidation. Speaking of working capital, this refers to the funds you need for your day-to-day operations. Loans for working capital can help you manage cash flow, pay expenses, and support short-term business needs. Now let's talk about interest rates. This is the cost of borrowing money, expressed as a percentage of the loan amount. Lower interest rates mean you will pay less over time, which is always a plus. The repayment term is another important concept. This is the length of time you have to repay the loan. Longer terms usually mean smaller monthly payments, but they may also increase the total interest you pay. Collateral is another term you should know. This refers to the assets you pledge to secure a loan. If you default on the loan, the lender can seize the collateral to recover losses. However, some loans, like certain lines of credit, may not require collateral. Your credit score is also a key factor in the loan process. This numerical representation of your creditworthiness is based on your credit history. A higher credit score improves your chances of getting approved for a loan and may even get you better interest rates. A down payment is an upfront payment you make when obtaining a loan, often expressed as a percentage of the total loan amount. Some loans, especially for real estate or large equipment, may require a down payment. Minority certification is the official recognition that your business is minority-owned. This certification is often necessary for eligibility in minority-specific loan programs. You can obtain this certification through agencies like the Small Business Administration or the National Minority Supplier Development Council. The loan-to-value ratio is another term to familiarize yourself with. This ratio compares the loan amount to the appraised value of the asset you are financing. Lower loan-to-value ratios are generally less risky for lenders. Debt refinancing is the process of replacing an existing loan with a new one. This is usually done to secure better terms, such as lower interest rates or longer repayment periods. Microloans are smaller loans, typically under $50,000. They are often targeted at startups or businesses with limited credit history. Microloans can be easier to obtain but may come with higher interest rates. Finally, a line of credit is a flexible loan option that allows you to borrow up to a set limit and repay repeatedly. This is particularly useful for managing fluctuating cash flow needs. By understanding these terms, Asian American entrepreneurs can prepare stronger loan applications and manage repayments more effectively. Knowing about minority business loans and small business administration loans can help you access capital with favorable terms. Awareness of credit scores and collateral requirements can also improve your chances of loan approval and help you negotiate better conditions.